Welcome, everybody. We're delighted to extend a warm welcome to all of our esteemed economic development partners and AEP customers that are joining us for today's webinar. Your presence is a testament to the collaborative spirit that drives our shared commitment to fostering economic growth and prosperity within I&M's footprint. So as we gather virtually to explore strategies, understand our current economy, and chart the future for sustainable development, we want to recognize the invaluable role that each of you plays in shaping our economic landscape. Your expertise, dedication, and vision are essential components in our collective efforts to build resilient communities and drive positive change. So today you will hear from AEP's Managing Director of Economic Forecasting, Dan White. He is our esteemed guest today. We encourage your participation via the chat and the polls that will pop up. Shelley Klug will be monitoring our chat and posing questions to Dan throughout his presentation. So once again, want to welcome you to our Economic Development Partners webinar and Utility Economic Outlook. We look forward to productive conversation. Next, I want to introduce, or perhaps reintroduce, my team members here at I&M that are leading today's presentations, Shelley Klug and Nate Paulson. Shelley covers our northern Indiana or northern I&M areas, which include Southwest Michigan, South Bend, Elkhart, and parts in between. And Nate is our newest team member, actually celebrating his first anniversary with the company just 2 days ago. Yay, Nate. So he's our newest member. He's based here in Fort Wayne, and he's been helping all of you get answers for your RFIs and coordinating projects such as this webinar. So now I'm going to turn it over to Shelley to talk about two of our site development initiatives. Shelley?
Hey, thank you, Ashley. Appreciate it. Welcome, everybody. Well, I can't see all your faces, but I know you're there, and we really appreciate you taking time to join us today. Just going to make a slight adjustment to my screen so that I am not distracted. There we go. Okay, so AEP launched two site initiatives within the last 2 years, which we have been actively involved with, Bright Sites and Step Up Sites. The purpose of the Step Up Sites initiative is to identify sites that are great in almost every way, but are missing something that is keeping them from the winner's circle. Throughout our analysis of sites in every state AEP serves, which, by the way, is 11 states, we discovered improvements needed from the electric utility perspective and some from an external perspective, such as due diligence studies or marketing support. The program is really a tool for our economic and business development managers to seek solutions for those needed improvements. For instance, for the electric needs, we are working with our distribution and transmission teams to add economic development, which in our view equals jobs, investment, and revenue, as a priority layer to raise the necessary upgrades to a higher level and therefore get the work needed done on a faster timeline. So in real terms, if you're looking at a site for a project with us and we only have 1 megawatt of distribution power and the project really needs 3 or 4 megawatts of distribution power, what can we do preemptively to get more power available to that site? So for external needs, as you know, we are often able to provide grants to you to move forward with things like due diligence and site preparedness. In this way, we hope to increase the marketability and get those wins. So that's in a nutshell, Step Up. We're taking a site that's great in a lot of ways and stepping it up so it's more marketable for that faster win. Now, Bright Sites is almost a follow-up to Step Up Sites. There we go. This program is another tool for us and actually for you to market key sites with good available capacity and competitive timelines. And we all know from doing all the RFPs recently, it's timeline, timeline, timeline. So we are still in the process of analyzing sites, but as we identify those that meet the requirements of the programs, we'll be adding the terminology Bright Sites to our Zoom prospector listings on the AEP website. We also would invite you to choose to add those to the sites we serve. Just make sure you check with us that it is actually a bright site before we use that term on the listings. So as you can see, the basic requirements include at a transmission level, we want the site or building to have transmission lines adjacent to the property with a minimum of 20 megawatts. And on the distribution level, we want the site or building to have three-phase, either already connected if it's a building or adjacent if it's a site to the property with a minimum of 2 megawatts. So let us know if you're interested in learning more, and we can actually, analyze sites that maybe you're looking at ahead of time and start talking about what this might look like in the lens of these two programs to see what we can do for you and work together on. So let us know if you're interested in learning more, and we are happy to work with you on that. And now over to you, Nate, for an update on the Economic Development Rider.
Thanks, Shelley. As Ashley iterated, my name is Nate Powles, and I'm an analyst on the economic development team here at I&M. And over my first year, I've spent a lot of time dealing with the EDR, or Economic Development Rider. I know a lot of you may be familiar with it, but I thought this would be a great opportunity to discuss the program as there's been some changes. And one of the reasons why we like to talk about the EDR is because it's a great program for our customers to take advantage of. And it's something we certainly recommend that you having the conversation whenever you're talking to economic development projects with clients, consultants, things of that nature. And essentially, what the EDR it's an incentive for new and existing customers. Whether it's a new meter service coming to fruition or an expansion effort to an existing meter of service, new and existing customers in both Indiana and Michigan can take advantage of the EDR. There are some differences between the two states, so I was going to outline those and just kind of share those, and obviously we can follow up with questions. Looking at Michigan, whether you're a new or existing customer, the threshold to qualify for the EDR is adding a minimum new load of 300 kilowatts. However, in Indiana, the minimum load for new customers is 500 kilowatts. And in Indiana, if you're an existing customer, the minimum new load is to add 250 kilowatts. And there's also factors that go into that as well, as far as investment made and jobs created. Another big difference between the two states, Indiana and Michigan, is where the billing credits are applied. In Michigan, the billing credits are applied to your kilowatt usage over the course of 5 years over an 8-year contract, whereas in Indiana, the monthly billing credit is applied to the total non-fuel fuel bill over the course of 7 years on an 8-year contract. And that just came into play this summer. The new EDR2 for Indiana was approved. So that is the biggest change that you'll see. And in closing, if you guys have any questions regarding the EDR, please don't hesitate to reach out to myself, Shelley or Ashley regarding this. We definitely want this to be in the conversation when we're trying to attract new business to our service footprint. And with that, I'm going to go and introduce our speaker today, Dan White. I'm going to give a little background on Dan here before he talks. Dan, similar to myself, has recently joined AEP. He joined in March of 2023 as the Managing Director of Economics and Supply Forecasting, where he is responsible for directing economic fundamentals, load generation, customer, and revenue forecasting efforts. Prior to joining AEP, he was a Senior Director of Economic Research at Moody's Analytics, where he led the firm's economic consulting practice and contributed to economic research with a special emphasis on government and public policy. At Moody's, Dan regularly presented to clients and conferences and contributed to various print, radio, and televised media outlets ranging from CNN to Wall Street Journal. Dan is a part-time member of the economics faculty at Villanova University and started his career as a financial economist for the state of New Mexico. And with that, I will turn it over to Dan.
Thanks, Nate. I didn't realize you were going to read the whole thing, man. Sorry, I would have sent you the shorter one. I hope I can live up to that.
We wanted to pump you up here for our guest today, so no pressure.
I hope I can live up to half of that you just mentioned. So,
sure.
Thanks so much, everybody, for joining us today. I'm going to try and keep you all awake halfway up the afternoon with some economics outlooks today. Specifically, we're going to talk about the economic outlook for the I&M footprint. So, the southwest corner of Michigan. I've been in Michigan long enough to know to do that, and most of northern Indiana. So we'll talk about that. We're going to talk about where the U.S. is going with the economic outlook, how that filters through to that I&M footprint, and then give you some hints about how things are going using some of the load data that we have access to here at AEP. Before we do that, though, I think we've got a poll question. Is that right, Nate?
That is correct. We have two. One deals with, it should be popping up for our guests right now. When will the next recession occur in the United States? There's no right or wrong answer here, so go ahead and select a
They're all
choice.
wrong.
They're
The
all
best part about
wrong.
economics, they're all wrong.
And then we also have a second one. I'll launch that one here as well. So you'll have two questions to answer, and then we'll go over the results.
I want to see how our results are coming in here first before we get to the next one.
Oh, um,
Wait, come on, Nathan.
nope, sorry.
I can't see any of the results, Nathan. Are they in yet?
I'm showing right
You,
now.
you may have to slide up and down to see the poll and the results. I had to slide up and down a little bit.
Oh, I see the second question. I don't see the first one, the one about the U.S.
Right now, I'm showing that 35% say we are in a recession right now, followed by 25% saying what is a recession, 20%
That's good.
saying 18 months, and then 6 and 12 months respectively have 10%. So the winner in the clubhouse right now is 35%, or we're in a recession right now, and then the rest, the 25%, aren't sure or what a recession is. So
Gotcha. Well, I love the honesty of the folks who are saying, what is a recession? We'll talk about that. Any more requests? Come on, there's 50 people on this. There's only 20 responses. You can't even be wrong.
I will say it was a little tricky just scrolling up and down in the chat to make sure you submit. So I see 34 responses.
There we go. 34 for Indiana, Michigan, and 23 for U.S. So some of you are more confident in your call about Indiana, Michigan than the U.S. I see how it is.
I see we
All right.
have 26 responses on the US question. So if we want to start with
All right.
the US, we'll go there.
So for the U.S., what I'm seeing, and tell me if I'm seeing the wrong thing, is 34% of you, at least a third of you, think that we are already in a recession nationally. But then half of you think, or about another third think it's at least a year out. And then about a quarter of you are very honest in saying that we don't know what a recession is, which is helpful. And it looks like for Indiana, Michigan, those numbers are pretty darn close, but a couple more folks think that Indiana and Michigan, the area, is in a recession now than the U.S. do. Right? Oh, there's more coming. All right. So here's the good news. The good news is we are not in a recession now. Right? And for those of you who don't know quite what a recession is, the factual matter is that there is no defined uniform answer across all of economics of what a recession is. So in the United States, a recession is technically anything that the NBER says it is. And the NBER stands for the National Bureau of Economic Research. It's a group of economists in DC and across several universities across the country who are the official referees and arbiters to say that we have gone into a recession or we have come out of a recession and when we've done it. Now, the good thing, because we're economists, we reserve the right to change our mind at any time. And so the NBER usually won't say that we're in a recession until we've already been in a recession for probably 6 months. The standard rule of thumb that you're most likely to hear, but the definition of a recession is whenever the GDP, so the national economic activity, whenever that has declined or contracted for 2 consecutive quarters, most people say that we are in a recession. Now, that's not uniform. We had 2 consecutive quarters of GDP just a few quarters ago, and we weren't in a recession. And there are other instances where we haven't had 2 consecutive quarters of GDP decline, but we have been in a recession. So the 2001 recession, for example, is a great historical episode of that. So the bottom line is we are not in a recession because we are not seeing widespread or sustained economic contraction. So that's what we would have to see in order for there to be a recession. We are not seeing that, even though we are seeing some pretty painful stuff across the country. And so, Nathan, am I switching slides or are you? There we go.
There we go.
All right. So really the determining factor of when we go into that next recession is determined by the relationship between the labor market and prices. And so what you see here in front of you now is basically wages and is measured by the cost of employment and inflation. So the ECI is the Employment Cost Index. It's something that the BLS puts together for us. And this is akin to not just people's wages, but their entire compensation. So their healthcare costs, their retirement costs, the amount of taxes that you have to pay on an individual. So think of this as the cost of employing somebody from the employer side. There's two lines here that I want to focus you on. The first is that blue line. That's the ECI for services. And the red is the ECI for goods producers. And the reason I've broken these out is because in your neck of the woods, goods producers make up a much larger share of overall employment than the national average. And so that red line is going to be very important. What you'll also notice about that red line, if we go back in history, if you go back to 2007, 2008, is goods producers tend to lead us into a recession. In other words, they are the canary in the coal mine, so to speak, with the showing weakness before the rest of the economy. And so the fact that we are starting to see goods producers decline more quickly than service providers is something that we have to be concerned about, because that's usually what happens when we go into a recession. Now, the green line that you're seeing here, this is core inflation. So this is the CPI number that also comes from the BLS. This is the big one that the Federal Reserve and everybody's been very concerned about. Core inflation, though, is overall price levels if we take some of the really volatile stuff out. So if we take energy out, if we take food prices out, if we take things that are a little acyclical from time to time and distort the picture. This core inflation number is what the Federal Reserve is laser focused on right now when it's trying to bring inflation back into check. Now, normally what the Federal Reserve likes to see is it seems to see about a 2% inflation rate. So you can see how much higher we are above 2% inflation. You can see last year we were 3 times what the Fed's target was. We've made some significant progress in that, some very painful but significant progress, because the Federal Reserve has put some very tight monetary policy in place. In other words, they've raised interest rates very high. They've increased the cost of borrowing across the entire economy. And by doing that, they have really decreased the amount of demand that's out there in the economy, which hopefully will keep prices from rising as high. Now, the reason that this relationship is important, and the reason you're seeing it on the chart in front of you here, is that total compensation is a direct input into prices, right? So if I have to increase the amount of money I'm paying my employees, I probably have to recoup that by raising prices. Also, the more money I pay my employees, the more money they have to go out and spend on things. And the more money there is out there spending on things, the more demand there is in the economy. So it's kind of a vicious cycle. The more we see these red and blue lines come back down into the 3 to 3.5% range, the more progress we're going to see in that green line falling back to 2%, which is where the Federal Reserve wants to see it. And until the Federal Reserve starts to normalize interest rates a little bit, we are just not going to see, we're not going to be out of the woods, so to speak, in terms of trying to fend off a recession. So I know in our business, we have a very capital intensive business. We are very keenly focused on what the Federal Reserve is going to do. And until we start to see the job market weaken, we're really not going to see much of a headway in terms of seeing lower interest rates. If you could switch to the next one, Nathan. Now, we do know that the labor market has weakened pretty considerably over the last 6 to 12 months. If you look at overall data, it's come down quite a bit, but it hasn't weakened enough. So the chart that you're seeing here is, I'm throwing a couple doozies at you here first. I promise they get easier after this. So this is what we call the labor supply gap. So this is basically all of the people who have a job plus the job openings that are out there, minus the amount of people who are looking for a job. And what that basically means is if this number is positive, that means that we have more people looking for workers than we have workers being willing to fill those jobs. So we have a very tight labor market. We have a shortage of workers. The red line that you're seeing there, that is the average going into 2019. And you can see that going into the pandemic, we actually had a very tight labor market. It's one of the reasons why most economists were calling for a recession to happen around the time of the pandemic, with or without COVID-19. So a lot of what we're seeing is kind of leftover strength in the labor market from before the pandemic even began. Bottom line here, though, is until this blue line gets back below that red line, or at least gets close to zero, we are going to continue to see wages bid up. We're going to continue to see employers looking for work, and workforce being an incredible part of the economic development strategy all over the country. Now, that's especially the case in the I&M territory, and we'll talk about that in just a second. So we need to continue to see this to decline. We need to continue to see the labor market weaken. But the obvious question to follow that is, how weak is too weak, and what can we be watching in order to hold off a recession, right? So maybe if you could go to the next slide. There we go. So it's going to sound very counterintuitive, but over the next 12 months or so, bad news is really going to be good news. So anytime you see the job number come out on Friday morning and people are disappointed with the number, that's probably going to be a good thing for the overall economy, because that means that we're probably going to see inflation continue to come down. Now, the red line that you're going to see here is, and the blue line, they basically explain what we call the rule of 250. So 250,000 is kind of a key measure in the labor market right now, and that's that dotted line you see there. The red line, those are the new jobs that are being added each month. So when you see CNBC the first Friday of every month, actually it'll be tomorrow morning. If you've never seen nerds, really geek out about a number, I would highly recommend that you go on CNBC tomorrow morning about 8:30 and just watch the Chicago Board of Trade and everybody freak out as soon as that number gets released. And folks like me will be arguing on TV plenty about what that number is. So that number comes out once a month. It's from the BLS. It measures the amount of new payrolls that are being added every month. And generally, we want to see that number right in around 250,000. If it gets too far beyond 250,000, that means that we're really growing quickly, and that's when we start to see inflation build up. If it goes below 250,000, that means that we're starting to see the unemployment rate start to tick up, and that means that the economy is weakening. The blue line that you're seeing there, that's the initial weekly claims for unemployment benefits. That actually came out this morning. That is kind of the counterfactual to the red line. So this is something that's measured on a weekly basis, and it tells us how many people are actively looking for unemployment benefits. So how many people have been laid off, how many people have lost their jobs, how many people are no longer employed. And whenever we see this blue line tick significantly above 250,000, that's when we know, again, that unemployment rate is increasing, that the economy is significantly weakening, and that we're probably heading into a recession. If both of these lines cross over that 250 mark for a significant period of time, and by that I mean 2-3 months in a row, you can almost bet your house that there's probably a recession coming. Now, you can see over the summer and in the spring, both of those very briefly kind of crossed over that 250,000 line. And that's why everybody really kind of freaked out about how weak the economy was over the summer. So even though we were seeing very strong GDP numbers and income numbers, everybody thought that we were about to head into a recession. The labor market, though, has proven incredibly resilient. And so even though we've seen this red line, so the new jobs coming online, fall below that 250,000 line, we're not seeing massive layoffs. We're not seeing a bunch of people lose their jobs like we would normally see. So what we're seeing is employers under a high interest rate environment start to pull back on new hiring, but they haven't, at least in large numbers, started to lay people off yet. And so until we start to see those layoffs tick online, we've got plenty of room to run in terms of trying to squeeze out the rest of that inflation. And it's unlikely that we see the Federal Reserve really think about lowering interest rates until we see core inflation back down around 2%, or we see this blue line really start to tick up in earnest. Does that make sense? If there's any questions, by the way, during the presentation, please feel free to type them in the chat. We've got some folks who are monitoring that, and I'm happy to address any of those as we go along. We'll also have a chance to ask questions at the end of the presentation as well. Okay, so that's the kind of 30,000-foot view on the U.S. economy. We are going to talk a little bit about the I&M specific picture here. All right, so these are the various metro areas, so official MSAs that are defined by the government within the Indiana-Michigan service territory. The size of the circle equates to the total number of jobs in that particular area. So you can see Fort Wayne is the largest circle. It has the most jobs in it, and then Michigan City, LaPorte is the smallest circle. It is the smallest in terms of overall payrolls. What this chart is supposed to show us is basically the momentum of a specific metro area, and also kind of where it is in the business cycle, because I think that's very important. So one of the things I asked was, when is the next U.S. recession? And then when is the next recession in Indiana, Michigan? And it seems that people were much more pessimistic about Indiana, Michigan than they were about the broader US. And so it's helpful to look at data like this to see really where the Indiana, Michigan territory is within the business cycle, because one thing that is for sure about the next business cycle is that it's not going to affect all metro areas uniformly. One of the things that we kind of were spoiled in the last two recessions is everybody kind of went into recession at the same time, and everybody more or less came out of recession at the same time. Historically, that's very atypical. So if you look back at all the recessions, throughout most of the 20th century, we saw parts of the country go into recession, parts of the country say, what recession? There was no downturn there. And so the next downturn we can expect to be much more nuanced when we look at that. And so it's very important not only to look at your part of the country, so Indiana, Michigan, but also look at your part of that region, because there are certain metro areas in the Indiana, Michigan territory that are going to react and behave differently than other metro areas when that next change in the business cycle comes. Okay. So two ways to look at this chart. The first is on the y-axis. So if you could go back real quick, Nathan. If you look at the y-axis here, that is the employment change since the start of the pandemic. So in other words, the higher you are vertically, the better your recovery has been since the pandemic. So Fort Wayne and Elkhart have both recovered more since the pandemic than any other metro areas in the I&M territory. They are the only two that have performed better since the pandemic than the U.S. average, which is that red box you see there. When we look from left to right, that tells us how a metro area has performed just in the last 12 months. And so you can see Elkhart, for example, even though they have seen significant job growth since the pandemic began, they've really had a tough couple months here as the RV industry has started to pull back after the pandemic. We're down almost 3% year over year in Elkhart in terms of employment. Fort Wayne is continuing to do the best. The top right corner here is really where you want to be. And then everybody else is kind of lagging behind. So they haven't recovered from the pandemic yet, but they are seeing some growth, at least over the last 12 months. Normally, the way that we expect to see this happen is everybody is going to move more or less counterclockwise, right? Mathematically, that's what happens. So eventually you start to slow, and you will move from the right quadrant to the top right quadrant to the top left quadrant and all the way down. So Elkhart is very advanced in terms of their business cycle, given all the growth that they saw in the RV industry, and they will start to fall back into that down side of the business cycle. All these other folks, so South Bend, Niles, Michigan City, Muncie, they are kind of in the ascendancy. So they haven't fully recovered from the pandemic, but they're still growing over the last year. And you can expect to see them move up into that top right quadrant over the next several months. Okay? That kind of gives you a good flavor of where folks are. If we go to the next slide, though, this is where we are in terms of wages. And this kind of helps to show that wage and household wealth is not necessarily the same as employment. And this is a big part of the business cycle as well. So even though we're seeing Elkhart, moving to the left in terms of wages, the average wages that are being paid out in Elkhart are still very strong. So as we start to see employment growth kick back in over the next 12 months or so, Elkhart will start to see an outsized impact from that job growth. There are other areas, though, like Muncie, for example, where the wages in Muncie are significantly lower than they are in the national average, and they're not growing as quickly. So even if we see more jobs start to come online, we are not going to see as much of a bang for the buck in terms of Muncie, in terms of overall GDP in the area. The two that you will see really stand out here are obviously Niles and Benton Harbor. So they've done pretty well since the end of the pandemic, but over the last 12 months, they've had some problems. That's especially in the Benton Harbor area with some of their manufacturing, Whirlpool, those kind of folks. On the flip side of that, we've got Michigan City, which is all the way over here with plus 10% over the last year. That is a result of all the development that they've got going on there, especially some of the initial phases of the GM Samsung plant and some of the new wages that are showing up there. Okay. Nathan, you want to go ahead and take over? So what I want to point out for you in that particular case, and this is going to play a significant role in I&M, is the amount of not just wages that folks are earning, but also their household wealth. This is a chart that is for the U.S., This is something that we have been keeping a very close eye on throughout the pandemic because it really shows how consumers are behaving in and around the business cycle. So this green mountain range that you're kind of seeing at the top here, that's household currency and deposits, and that's adjusted for inflation. It's also adjusted per capita. So it's the amount of money in the U.S. per individual in the U.S. In other words, how much money, if you took all the money in the U.S. and you divided it by all the people in the U.S., how much would be out there? And this is just straight cash. So this is not invested in investments. This is not in the savings account. This is in just people's bank accounts. There is a lot of cash that is still out there as a result of the pandemic stimulus that came out after COVID-19. So a lot of money that flowed out into folks' bank accounts, and we started to see some of that be spent away, but we haven't seen all of it be spent. There's still a lot of cash out there, which is one of the reasons why we're starting to see consumers continue to buy things, especially at the high end of the income distribution. The caveat to that, though, is this blue set of bars that you're seeing underneath. So this is that same data from above, but it's broken out by income quintile. So it basically take the entire income distribution and divide it by 5. The fifth, which is the lowest here, just for some context, those are households that are making less than about $28,000 a year. The fourth quintile is about $55,000 a year. So the two folks that you're seeing on the far left here, those are households making less than $55,000 a year, which actually makes up for quite a bit of the I&M service territory. And depending on where you are located within the I&M service territory, you will know if you are in an area that is specifically high income or particularly low income. The point being that folks who are lower income households have much less cash than they have had historically. So this blue line measures how much cash those folks have in their bank accounts relative to what they had before the pandemic. Okay. So you can say, yes.
We have a question right on this slide. When is that cash expected to return to pre-2020 levels?
That is the $20 trillion question, right? So whenever this gets back down to pre-2020 levels, that means that all of that excess cash has gone out of the market. And for some households, so again, these guys who are in the $55,000 income level and lower, it already has come back to pre-2020 levels, right? So if we look at the highest income earners here, these are folks making more than about $250,000 a year. You can see that they are at about 1.15% of the amount of cash that they had before the pandemic. So that's adjusted for inflation, and that's looking per household, right? So we are seeing those folks still have a lot of cash around. What they do with that cash will determine whether or not we go into a recession right away or whether we do something else, right? So if they take that money and they invest it in something long-term that's going to boost productivity, it's going to give us a lot of bang for our buck in terms of economic growth over the next several years. If they go out and spend that money and put it through their economy, then that'll have some boost in terms of economic activity as well. But if they continue to just sit on it like this and keep it in a checking account and not put it in one of those more economically productive areas, then we'll continue to kind of see economic growth kind of just level off and go along. But what we're concerned about and what we want to make sure we're keeping a close eye on is what's going on with these folks in their households and making sure that our customers especially have access to economical and reliable sources of power. And also to make sure that they have access to some good job opportunities as well. And that's something that I know that our team is working very hard on in the I&M service territory. Okay. Now, we're seeing this play out in action when we look at our load data. Nathan, if you can go to the next slide. So this is another bubble chart. I apologize for throwing all these bubble charts at you, but I think they're the most effective way to really look at a number of different areas all at the same time. So these are all of our different operating companies, and you can see that the red box there is the AEP average. You can see I&M in terms of residential load. So this is the amount of electricity being used in total within our service territory. Within I&M, in the third quarter, they were down more than 1% year over year. And over the last 3 quarters, so year to date through the end of the third quarter, they were down about 0.5%. In other words, even though the economy is increasing. GDP was up more than 5%. Wages are increasing. Employment continues to increase. Even though we have all that, folks are still not feeling as wealthy as they did maybe 12 months ago. And so they're pulling back on electricity usage, and they're pulling back in other parts of the economy as well. And they're going to continue to feel less wealthy until, as Ashley or somebody noted in the text, until we get that 2020 level of cash. We're back there, or we are starting to figure out where that cash is going to go, if that makes sense. Fair? Okay. So that's the story on residential load. And in terms of our individual households, we're not going to see a tremendous amount of growth in that area, or at least from consumers over the next 12 months. That's not just for AEP, but that's all for all of the businesses in and around the I&M service territory. Those of you relying more on consumers are going to see things continue to weaken. Where we see signs for optimism and where we're excited when we look at future growth, it's really in C&I, so commercial and industrial load, but also the businesses that go along with those. If you could skip to the next charts there, Nathan. So this is our industrial load. You can see, and this is why I wanted to really focus. So even though we're starting to see in Michigan City, for example, those wages start to kick up because we're starting to do some work with the Samsung GM plant, we are not seeing that really at its peak yet. And this shows that. So if we look at load for industrial and I&M, we're down about 1% in the third quarter, and year to date, we're down about 2%. That is going to change as more of those factories get back up to full capacity. And as those new installations, those new factories, the new plants, they start to ramp up their activity. They ramp up their hiring. They ramp up their economic activity. Industrial load is a really good leading indicator of what economic activity is going to be. And so even with all of that, we're starting to see a little bit of a decline. But as I mentioned before, this moves in a counterclockwise direction. So very soon we will expect to see this I&M bubble in the bottom right-hand corner and then working its way up into the top right-hand corner as more of those new developments come online. Right? And we're already starting to see that in our commercial load in particular. You could skip to the next one, Nathan. And somebody made the point that the GM Samsung plants in New Carlisle, which is right in between South Bend and Michigan City, the port. So we are seeing, when we look at the jobs data, some of those jobs fall into that Michigan City, the port service territory, which is why not service territory, but the metro area, which is why some of that data looks a little weird.
Hey, Dan, real quick, do you want to kind of distinguish between what we consider industrial load versus commercial load?
Oh, absolutely. Yeah. See, you guys have already brainwashed me, Ashley. I've been here for 7 months and I just assumed that everybody knows the difference between commercial and industrial. So commercial and industrial, if you think about it like NAICS classifications, industrial load is really anything that's a goods producer. It's not exactly one-for-one goods producers, but construction, manufacturing, those kind of folks, natural resources, those guys are all going to fall under industrial. Commercial load is really any large-scale services. So any one of your commercial services or your personal services, those kind of things, those would fall under commercial load. And that's where we're really excited because we're starting to see some of the great work that's been done in terms of economic development coming online already in terms of our load. So if we look at commercial load, you can see that I&M is up 7.5% in the third quarter and 7.5% for the whole year, which is right on line with what we're seeing in AEP Ohio. It's what we're seeing in some of the other places that are a little farther along in terms of their tech development and data center development. Most of this progress that we've seen in I&M so far, especially over the last couple months, is in data center development, and we expect to see more of that. So we're already starting to see some of this development on our load. The other thing that we're really seeing that's encouraging is more of the growth that we expect to see over the next 12 to 24 months in the I&M service territory is driven by things outside the typical I&M manufacturing footprint. So data centers, some of those more high-tech manufacturing type jobs. The more that those come online, the more those can be kind of a self-fulfilling prophecy and attracting other types of similar manufacturers. We've already seen that to some degree in Central Ohio, and we've seen it in Texas, certainly. And so the outlook for I&M, it can be very optimistic, especially if we continue to see those kind of developments come into place. Okay. Now, I've heard my own voice for way, way too long now, Ashley and Shelley. So if there's any questions amongst you guys or amongst the folks, I'd be more than happy to answer them.
If anybody has a question, feel free to drop that in the chat.
Sometimes it's that I'm so convincing that nobody dares to question it. They just go, I'm totally bought in now.
And we'll also have an opportunity to do questions at the end if anybody is still, their mind's still churning about Dan's presentation there. So, but with that, I believe
I had a question. If I'm
sure.
allowed, am I allowed? Okay.
You're allowed.
Of course.
I mean, thinking about with the economic development folks we have here on the call today, are there any particular industries? You mentioned the RV industry kind of slowing down a bit post-pandemic and everybody going out to buy RVs and boats and things like that. Are there any other industries that we should be watching carefully or closely that may be on the decline?
Yeah, absolutely. So the RVs are a great example of really cyclical consumer industries, who really have just been for a roller coaster ride over the last 3 or 4 months. So RVs obviously went up when all that pandemic money came in, all the stimulus money that came in from the government. Folks were spending on those, and with interest rates where they are today, even if people still had that level of income coming in, it would be very difficult to maintain the level of sales that we saw on that. So anything that's really interest rate sensitive, so housing market, you're probably seeing less homes being built. Autos, we started to see a little pullback of that. Interesting enough, we didn't see the same degree of a pullback in activity in auto manufacturing that we have normally seen from the UAW strike. The way that strike was handled this time around definitely lessened the impact. But that being said, we have seen a pretty noticeable pullback in auto manufacturing even before the UAW strike. Again, it's a very interest rate sensitive industry. And so those are the things that really are going to remain weak for the next 6 to 12 months, at least until the Federal Reserve decides that they're going to take their foot off the brake for a while.
I had another question, Dan. It's almost a logistics question in a way. We recently were studying where people live versus where they work. And a lot of us do that for projects so that we can show the labor force that could be brought to a project. So when we count those wages, is that from where they are residentially or where their jobs are? Because that can be across state, across counties. I was just a little bit curious about that.
Yeah, no, in the I&M service territory, that's very important, right? Because that state line is very blurred as you're driving back and forth. I remember, so I have family in the Dowagiac area, and I remember driving down to Mishawaka all the time to spend money, and then you drive back over to Michigan.
Yes.
And then I worked for a state, and I realized what the sales tax implications of that were, and I got really embarrassed about it. My grandmother used to always do that. But the wage numbers that you see there are based on where those payrolls are located. So wherever the payrolls are being recorded, that's where those wages are. So even if those folks are living across the border and driving in Michigan, and they're driving into Indiana to work, those wages would show up in Indiana as opposed to Michigan.
Okay, yeah, that I thought that was interesting because we have a lot of that flow, as you can imagine. I mean, it is both directions. The other question I had was somewhat related to that and also related to the GM project, just because that one is going to have such a huge construction jobs impact.
Right.
So construction jobs, how do you account for those?
So construction jobs are captured in the labor market data that we see. Nathan, if you want to go back just a couple slides to the metro area employment. There you go. So those would all be captured in here. So the construction jobs, and they really only show up materially when they are for a very long-term project like the Samsung battery plant, and the GM battery plant, because that's a 2-3 year construction phase. Those are things. There are some things that are so specialized that you may be bringing in workers from outside the area to take those jobs or to do certain roles. So those have a much bigger economic impact than, say, housing construction, for example, where those crews are probably already in the area. They're just going from one existing job to another existing job, and building that out.
Thank you, because that is exactly what the GM one is going to be like. Is a lot of specialized jobs coming in. It's similar to when those of you who are familiar, when our Cook Nuclear is refueling, we suddenly have 2,000 to 3,000 extra workers come in locally for a few months, and so so that actually really helps our hospitality industries as well. So very
Totally.
specialized, certain period of time, but there's an impact.
Yeah, and it's important to that point, especially, Shelley, because we just talked about how the consumer industries are probably going to be the ones who are most negatively impacted over the next 6 to 12 months. So the fact that there is an outside force coming in and kind of pushing extra economic activity in that area is going to be much needed.
So I know these people on the phone on the webinar, and I'm so delighted that they're just sitting there thinking about this, because I think I'm going to get emails afterwards with some questions, is what I think.
Well, I know that economic development people are usually pretty shy, so that's probably why they don't want to ask a question.
I'm double checking that the chat works. If anybody saw and can respond, that would be great. Otherwise, we have a problem, and we will take your questions via email.
Yeah, we're happy to do that.
Dan,
Yeah.
Dan, I have a question as well. So just to kind of round it out, but as everybody's aware, we're heading into a big election cycle, with a
Hmm.
presidential election, and just curious in your experience, how does that affect the general dynamic of the economy as far as from like a consumer perspective and also from like a company perspective? Is there anything historically in the past, when presidential elections, does it cause people to freeze up, to not take as many risks, to kind of play the waiting game? What are they with what's your thoughts on that? Because it's
Yeah.
obviously we're going to be in the thick of that here pretty soon.
Yeah, whether we like it or not. So get ready to see all
Mhm.
the political ads on your televisions for the next 9 months or so. Um, it this is going to sound like an economist answer, but it depends. So most of the time, folks go into a business or a election cycle, and from businesses to consumers, they tend to be a bit more cautious, because they know that things can change. But it's usually a little bit of caution. The last 2 or 3 elections we've had, though, it's been a significant amount of caution, a measurable amount. When we look at the economic data, we can see people actively pulling back on making decisions because they're genuinely concerned that if there's a transition in leadership, that whatever the regulatory regime or the tax regime or all these things are going to change pretty dramatically, because the policies that are being put forth by both sides are pretty significant. Even if they agree with the change that is going to be made, the fact that it's going to change and they don't know what that change quite looks like can really cause a lot of uncertainty and a lot of pullback in investment and hiring decisions until they have a better idea of what that looks like. The economy loves certainty. So they love to know what regulatory policies and what tax policies are going to look like many, many years out. And the more certainty they have, the more they can make some of those long-term investment decisions, regardless of whether or not they agree with it.
Dan, there's a great question, and it's great for several reasons. Partly because of who it's coming from. It's coming from one of our AEP attraction, or it is our
Oh,
AEP
I
attraction
don't
manager.
answer questions from Scott. No, I don't.
So this is a great question. All economic developers want to know, but this is Scott's main interest. So we talked about that what RVs might be impacted negatively in the foreseeable future, but what industries should we be focusing on growing and attracting? What is growing out there?
Yeah. Well, I mean, it's from an economic development perspective, typically the thing you want to go after is the thing that's going to bring you the most jobs, right? Because we talked about earlier, bringing in some of that economic activity is really important. But unless you're bringing economic activity from the outside in, it can be difficult to do that. And economic activity tends to follow demographics, so they follow the workforce. And so the more that you can attract a really good workforce, the better your long-term economic prospects are. Given some of the the educational institutions that you guys have in the I&M footprint, that should be easier than in other places of the country. So it's really important to chase those jobs and those higher paying jobs. Some of the industries that are out there doing that, there's a lot of going on in tech development. A lot of the clean energy stuff that's going out there plays really well with both the industrial kind of history of the I&M service territory and the educated worker force that you have. And so there are mostly things in that area would be something to aspire to, or to things that you already are attracting. If we look at some of the big wins from an economic development perspective that have already been going on in I&M, they all kind of fall under those categories.
Thank you so much. And thanks for the question, Scott. So we do have another comment and question, and we're happy about this. We did have a better year than expected in Allen County. Thank you for all those that participated in that. We saw higher numbers in capital investment, but more conservative job numbers. A lot of investment in equipment. Can you talk about the trade-off of interest rates and workforce scarcity for 2024? And we love your compliment. Thanks, Ellen.
Yeah, thanks, Alan. That's a great question, and it's something that we've seen kind of across the country. It's not necessarily unique to I&M. A lot of capital investment and much less in terms of workforce investment. And we normally see that when folks are very concerned about what the future of the economy looks like. So if I'm not quite sure what the economy is going to do, I don't really want to invest in my workforce. I want to invest in things that make my workers that I already have more productive and more efficient. We will start to see that change a little bit in 2024. We've had the cost of capital has been so high for so long now, and we expect it to continue for the next 6 to 12 months, that normally what will happen in this part of the business cycle is capital investment will pull back because it's just too expensive. Unless you've got the cash sitting around, it's just too expensive to invest in some of these items now. And you'll continue to pull back in hiring and kind of wait it out. It's kind of a wait and see what the broader macroeconomy is going to do. Unless an opportunity really comes and bites you on the nose, you're probably not going to chase it too much with interest rates being as high as they are. What we'll expect to see that change is the second half of this year, maybe early 2025, when the Federal Reserve starts to lower interest rates, capital gets a little bit more effective, or sorry, gets a little more affordable. And then folks will kind of play it by ear from there. If the Federal Reserve is able to pull off what it's been trying to do, which is this soft landing where we don't see a recession, but we do see inflation come back down to 2%, then I think you could see people really invest heartily both in capital and in their workforces. But in the meantime, I think you're going to see a lot of wait and see, especially from some of the bigger investors and companies in the area.
Well, thank you so much. Thank you, Dan. I think we have just a couple more slides to get through, and then if there's a minute or two left, we can see if any other questions have come up. But thank you so much, Dan. That was really appreciate that. Who says economists are dull? You're not. That's great. That was great. Thank you so much. This slide is just some successes in 2023, just some of the representative of the work we've done together with you. And we do want to thank you, our Lidos, Ritos partners, for your hard work and partnership in bringing these Michigan and Indiana projects to fruition. As you can see, there's a sampling here, a great mix of diversified industries, including RV. We talked about EV battery. Wanted to clarify which we did, where GM is, and New Carlisle. Since Bill is on the phone and Allison, we want to make sure we call that out. We also had some food and beverage, which I want to believe is always a worthy industry to attract because we all need to eat and drink. We've also had a cryptocurrency, very volatile, but we have had a successful project with that one, a couple of them actually, so fingers crossed, still going strong, and then quite a few in the advanced manufacturing field. So these projects alone have a combined investment of over $3.6 billion and 1,800 jobs. That is a lot to celebrate. So Ashley, what about next year?
Sure. Thanks, Shelley, and thanks everybody for all of your contributions over the past year and years before that. So looking forward to 2024, our team will be getting together along with the broader AEP Economic and Business Development Leadership Group to really chart the priorities or chart what next year looks like. And so our top priorities, as we've already discussed, are still going to be site development and our sector-focused business development strategy. We've had great success time after time. I can think of multiple projects. The GM Samsung project that Shelley mentioned up at the IEC in New Carlisle. That is a great example of how site preparation, site development work pays off. We've also seen that down in Muncie with the CanPack project a couple of years ago. I could go on, but we have great success from that, and we will continue to focus on that. We need your help. We need your input. We're always looking for additional sites that we can put into our portfolio and hopefully that we can invest in as well to bring those up. The other thing I mentioned there was our sector-focused business development strategy, and that's targeted economic development. That's just a fancy word for targeted marketing. We put together a strategy. This was mainly internally, but a lot of you have heard about this from us over the past year, where we identified, with the help of a third-party research group, 8 of the top growing industries in the United States that would fit well within our AEP service territory and specifically within I&M. Dan mentioned a couple of those a little bit ago as showing great opportunity. Those industries there are that we're looking at are on the screen, and the 2 that are in yellow down at the bottom are the ones that we selected or asked our research partner to look at specifically for Indiana and Michigan as rising to the top as showing great opportunity for growth and development in our service territory in both states. So you'll hear more from us on these in our activities. We welcome your partnership as we go out and try to target these companies, whether that is at trade shows or direct to company outreach, or influence or centers of influence like trade or industrial associations that go along with these specific industries. The other thing we're doing or will be doing more of is looking at our existing customer base. We currently now have quite a few customers that are either on the fringe of these industries or they are part of these industries, and we want to meet with them. We want you to join us along with our state partners, our retail partners, and our Lido partners. So let's be in touch about that going forward. Again, we appreciate everything that you all do for your communities, what you do in partnership with us. We look forward to an even more successful 2024 and welcome the opportunities to strategize with you. Over to you, Nate.
Thanks, Ashley. Just one last call for questions. If anybody has anything for the I&M team or for Dan on the economic side of things, drop those in the chat. We can see those, or shoot us a line or an email. I don't see anything right now, so I'm just going to kind of close things out. To reiterate what Ashley said, we definitely appreciate everybody participating today and attending the webinar. We appreciate your relationships with one another and look forward to collaborating with you in 2024. Can't stress enough how your success is our success and vice versa. You're our partner. We want to work with you and share successes together in our footprint. We went over a lot of material today, so we are recording this. At some point, we will have a recording available. So if you or somebody on your team wants to revisit this content, just reach out to one of us on the team and we can make sure that it's accessible to you. And from there, we're going to close things out. And, again, happy holidays, and we look forward to next year. So thanks, everybody.
Thanks, everybody.
Bye, everybody.